Fed is probably one of the most underestimated tools for a stock market, like ever in history. And a lot of folks don't understand why, or in my opinion, they don't understand. Even fund managers don't get this. They should, but there's a lot out there that don't. This is unprecedented stimulus, quantitative easing, unprecedented interest rates that we had in 2020. We had unprecedented Fed movement in 2008, but it's of my opinion that literally we've done in probably less than a month, we did close to 2.5x in terms of dollars of stimulus for this economy that the Fed did first, from comparing 2020 to 2008. That is huge. And we did it in a month. And as you can see here, so just for the viewers, so quantitative easing is just basically the Fed is increasing their balance sheet by buying CMBS and MBS, mortgage-backed securities. If y'all need some more information on it, you can Google mortgage-backed securities. And, you know, if for those that don't know what happened in 2008, let's just put it like this. It was a massive failure on both the consumer end and both on the banking end when it comes to mortgages, 1 to 4 family mortgages. But basically, in essence, the mortgage-backed security is what took down our system. It got fraudulent. It got overdone. There was too much premium on the bonds. There was an incredible amount of fraud within the bonds, meaning that, or toxic assets within the bonds. The underlying collateral of a mortgage-backed security is just basically a mortgage, essentially. And most of these mortgages were built up of, you know, guys with, or gals with, families with, you know, 500 FICO scores, 550 FICO scores, with very, very terrible DTI, or no income, no assets, no cash. They just had these big houses. So they were just, you know, these massive rich house people with not a lot in their checking account, or that probably weren't worthy of a mortgage of that size. Then you have this product called the adjustable rate mortgage, which kind of kicked it into gear, because the adjustable rate everybody was getting teased with what these called teaser rates, and everybody were so like enamored with, oh my God, I got 1% of my mortgage. And it was almost like a thing. I remember it back in 2008. It was like, I got a 1% mortgage. Well, is it adjustable? Yeah, it's adjustable, you know, blah, blah, blah. And it was like, you weren't cool unless you had an adjustable rate mortgage. That's how it was. It's pathetic. And people were bragging. I remember people bragging about, oh, my mortgage lender gave me this mortgage and I didn't have to, you know, show my W-2s. I didn't have to do this, that, or the other. There were millions of these out there, man. Millions of these. And that's what took down our system. So what does the Fed do? They buy these toxic assets from big banks to save the banks. Because if they knew that if the banks go down, that's up for a debate. You know, you could say, well, the American people are going to pay for that one day, et cetera. That's all up for debate. We're not here to argue that. But what we're here to argue is, or what we're here to talk about is how the stock market reacted when the Fed started getting to work.
Yeah.
Right. And so what's interesting about this is that with QE, the Fed started buying these toxic assets, and the market started to go up. QE was announced on November 25th, 2008. That was the first phase of QE, and it was expanded on March 16, 2009. I find it really interesting that was near the bottom of the market on March 16, 2009. Then the market rips higher and goes into another little mini bear market, I would say, kind of pushing towards June, really March, April 2010. We kind of fall, and look where the top was. March 31st, 2010, QE1 terminated. Pretty remarkable. This kind of goes on. You know, they terminate it, they announce another phase, they terminate, they announce another phase. So it's kind of wobbly along the way, and you kind of see how the QE was just sort of spread out over time, right? The quantitative easing and the Fed's actions were really spread out over time. Then let's fast forward for purposes of brevity here. Let's fast forward to 2020. And what does the Fed do? All right, so there's a few things that happen in here, but boom, the market takes a hit. By the way, the Fed was already kind of taking a little bit of action in here. If you recall, we had an administration that was very critical of Jerome Powell and the level of interest rates in 2018. Remember, late December of 2018, there was a lot of talk about interest rates, and then the Fed starts lowering rates and sees a little bit of a recession on the horizon, so they change their tune or whatever. But then COVID happens, and that's what we're really interested in talking about here. Look how much stuff the Fed did in such a short period of time. I have the dates here, and I had to put this all in one block of comment box here because there was just so much stuff that they did. They cut rates to zero. They had $80 billion in government bonds announced that would purchase $700 billion in assets over the coming months with no limit. Encourage banks to use emergency funding sources known as the discount window. It's just basically a short-term borrowing window for banks, by the way. Loosen capital requirements and reduce reserve requirements for banks. So every bank has to keep a certain amount of cash relative to their total assets. Coordinated international action to lower pricing on U.S. dollar liquidity swap. I mean, boom, creation of commercial paper funding. This is like business loans. Creation of money market mutual fund liquidity facility. U.S. dollar liquidity. I mean, boom, boom, boom. And then here we go. March 23rd, 2020. This was days after they announced this stuff. They expanded more QE, quantitative easing, established 3 new emergency funding lending procedures or facilities. They expanded the CPFF, the PDCF, additional flexibility to capital requirements of banks, scaled back regulation on banks. Fed provides relief to small banks. New York Fed to buy $1 billion in Fannie Mae mortgage-backed securities. I mean, unbelievable, unprecedented moves in the Fed. And if everybody wants to know why the market's doing what it's doing, I'm not. I don't want to know why sometimes, but there are times when the Fed is involved. I want to know why, and I want to know what's going on as to why the market is doing what it's doing when the Fed is acting. Otherwise, I really don't want to know. I don't want to get too involved in the news. But the Fed is a little different. You want to know. There's an old saying on Wall Street: the smart money follows bonds, and the smart money follows the Fed. And one of the biggest reasons, and you can kind of retweet this later, Richard, if you want, but one of the biggest reasons that got me onto the Fed was I remember watching an interview with David Tepper back in 2010, and I tweeted this, and it was with Joe Kernan on CNBC. I'm not big on watching CNBC or the news, but when that guy talks, I listen to that guy. He's a smart son of a gun. And he was buying at the March 2009 low, and he was buying financials, and he was buying stock. He was starting to, get into stocks, and a lot of it. And he said, just quite frankly, hey guys, well, the Fed is doing this. I mean, you follow the Fed. It's simple. It's not that hard. It's not rocket science. It's remarkable that, over time, you see these types of bull markets, and they're typically conducive to very dovish, a dovish Fed. Why is that? I think it's real simple. Just keep it simple. I keep it simple in my head, so I'm going to try to be simple here. Low interest rates means that it's easier to acquire. Debt's cheap. When you have low interest rates, debt is cheap. It's cheap for banks are not, they're charging, very low interest rates. Venture capital funds, hedge funds that do, credit strategies, they're charging very, very low in interest rates because there's a lot of competition right now, which is a good thing for the U.S. economy. But when the rates are very, very low, it creates almost like a demand for debt, and debt starts to pick up, and the Fed wants that because it's going to spur, loans to small businesses are critical in this country, and we need that. But when it comes to the stock market, it's easier to acquire a company if you get charged, 1, 2, 3%. Your returns are just so much better. Versus, if you're getting charged 10%, well, guess who's keeping 10% on that, cut of the pie? Well, it's the bank that is. And so, you have that. So you have, stocks can trade sometimes on the prospects of being taken out. So low interest rates provide more fuel to that fire. Buybacks, that's another big one when interest rates are low. Buybacks, stock buybacks, which can, bolster the stock price. The company itself. So if the company has, let's just say, for example, a lot of these growth companies, they have debt. Value companies have historically a lot more debt than growth. But there's a lot of growth companies that have debt out there on their books. And, when interest rates reprice downwards, whether they're tied to LIBOR, the London Interbank Offer Rate, or Wall Street Journal Prime, whatever that case is, when they reprice downwards, they're saving money because the interest expense on their books goes down, right?
Yeah.
So that's just more money to the bottom line, to EBITDA, to earnings per share, when you have such a low interest rate environment. It also creates an ability to borrow money on the company level, to invest in, to start new projects, to either buy new companies or to start new projects, or spend capital expenditures on maybe like a piece of machinery, a real estate facility, whatever it is, to basically increase their earnings, increase their sales, to increase their footprint. Maybe they want to expand into Europe or whatever it is, and debt's cheap right now, so they can do that. They can afford to do that. So that is in and of itself, the Fed is an incredibly powerful, underestimated, underrated tool for the stock market. And, hopefully I've laid my case out here for everybody, and I'm keeping it as simple as that. I don't really like to go too far else into it. A lot of people will overthink this, and, if the Fed does this or that or the other, and it's like they base their trading strategies 100% on the Fed, and you don't want to be too close to it. But this is what I'm saying is my point is that that's what's giving me the conviction to sit. That's what's giving me the conviction to stick with this trend. Until the Fed starts to, get a more hawkish standpoint or hawkish stance, where they're looking to raise rates, they're looking to taper quantitative easing. Taper meaning they're going to slow the growth of the balance sheet itself. When they do that, that's when I'm going to start, okay, we might need to, start raising some cash, assuming I'm going to let my positions, not the market, not the Fed, but I'm going to let my positions take me out one by one when they decide to take me out. But not, I'm not going to just start selling as soon as the Fed changes their footing. I need to see my true market leaders and my positions become weak or trigger sell signals for me to sell. So anyway, that's the Fed.